If you spent any time reading about investing, you'll have probably seen that you should include some bonds in your portfolio. They offer stability against the stock market and they can really provide some balancer to your overall portfolio. But I think it's one of the key areas where some of the theory that's delivered online doesn't quite match up with the reality as we see it on our own investing platforms. Because whilst you more or less might have an idea of what a bond is, or maybe you really don't, it doesn't necessarily mean that you know how or why, really, you should invest into them and in what way. And it's becoming ever more important in the UK. Recently, we've seen some major changes to the bond market and specifically how retail investors, so that's you and I as just regular people, can get involved in both corporate bonds and government bonds. And we're seeing ever more tech companies issue bonds as a way of raising money as AI is becoming more and more expensive. So in this video, I want to break down bonds, how you can read them, and crucially, whether or not you should invest in them. Hi and welcome back. My name's Zoe, and as a former wealth manager, this is my channel, Words on Wealth, where I break down key investing terms, jargon, and headlines to make you a more confident investor. And this video has come off the back of a request from somebody in the community, so if there is anything that you want to see, just let me know in comments. Just as a key caveat before I dive in as well, in this video, I'm going to be talking about bonds. That is the ones that are issued by governments and corporations. Don't panic if you don't know what I'm talking about yet, because I'm going to get into that. But crucially, I'm not talking about premium bonds. I'm not talking about municipal bonds. But they are different, work in different ways, and come with a different set of kind of criteria. Just so that you know as well, I'm going to focus on some changes here in the UK. But the theory is still the same, and the applicable side of what I'm going to say will go across the world. So let's dig straight into the theory. What actually are bonds? Well, bonds have multiple different names, which is why they're confusing, and they also cover different areas, which is even more why they're confusing. Essentially, bonds or fixed income-based assets are like an IOU. It's a debt to usually a government or a corporation, where you, as the investor, give money to them in exchange for a rate of return, which is, in the bond world, known as a coupon. If you think of it kind of like a mortgage, where you go to the bank to be able to borrow money, it's exactly the same with governments or corporations. They're coming to you to be able to borrow money, which they'll pay back over a set time period, and they'll have to pay a set rate of interest. Now, normally these time periods, and also who is issuing the bonds, will impact how much they have to pay in a coupon. So for example, if the government or the corporation is seen as higher risk, generally, they have to pay more in coupons to be able to borrow the money. Kind of the same, again, well, if you come back to the mortgage example, if you or I was deemed to be a riskier borrower, we had a poor credit history, then normally we have to pay a higher rate of interest because we're a higher risk. It's exactly the same with governments and corporations. Now, there are what is known as ratings agencies out there, three main ones to be precise. These are Moody's, Standard & Poor's, and Fitch, and they give ratings to corporations and governments as well to basically deem how safe they are as a borrower. And this helps to then dictate how much they have to pay in those coupons to be able to borrow money in the form of bonds. These range all the way from the top, like AAA rating, they have slightly different letters and terms, all the way down to what we call junk. Really, they do call it junk. Now, the second thing that dictates how much they have to pay in coupons is not just how risky they are, but also how long the bond is going to last for. Because some bonds can be super short term. I'm talking 30 days, whilst others can be up to 50 years. And the likelihood of the British government, for example, going bust in the next 30 days, I'd hope was relatively low. In the next 50 years, I'd still hope it's quite low, but I have to concede it might be higher, because we just don't know what's going to happen in the next 50 years. Now, normally when we're talking about government bonds, they are issued by a certain department of the government. Here in the UK, that is known as the DMO, the Debt Management Office. In different countries, they have slightly different names, but you get the idea. It's the same with corporations. They, on a set day, will issue a whole batch of bonds, debt, fixed income, and whoever's there on that first day can get access to them. This works in a really similar way to the stock market, where if you imagine when a stock first lists on the stock exchange, it goes through a process known as an IPO, an initial public offering. Those that are there on the first day will get the stocks, and if they decide that at some point down the line they don't want them, they then sell them to another buyer. Now, that first issuing is what we call the primary market, and when you're buying and selling those that you've already held when you weren't there on the first day, it goes into what is known as the secondary market. So the reason why this is important to note is because the secondary market of the stock market is relatively liquid, aka people are trading pretty frequently, and the vast majority of stocks, there's pretty much a large pool of buyers that are willing to take it off your hands. It doesn't mean that you'll sell it at a gain, you might sell it at a loss, but it's all quite transparent and easy to understand. The secondary bond market is a little bit more complex. Believe it or not, the bond market is actually bigger in size than the global stock market. But traditionally, it's been major institutions that have been the key players on the bond market, not retail investors, aka the likes of you and I. And so the need for that transparency has been lower, but also therefore the mechanisms behind the trading just aren't quite built in the same way as the stock market. The thing about bonds is that on the secondary market, they become ever more sensitive to interest rates. It's really important that we separate out bond prices and bond yields. Bond prices and interest rates have a strictly inverse relationship. So what that means is on the secondary market, when interest rates rise, bond prices generally fall. And when interest rates rise, what we normally see is that new bonds being issued pay higher yields, aka they pay more in coupons, which is why those old bonds or those bonds that are already on the market and looking to be traded on the secondary market become less appealing because generally they carry a lower interest rate. This is known in general terms as duration, and it refers not just to the duration of time that the bond has to go, but also, as I say, its sensitivity to interest rate changes. Normally, what we see is that bonds with longer durations will be more sensitive to fluctuations in interest rates. I find at this point that people start to switch off because they're like, oh my God, this sounds actually quite complicated. And in truth, it can be, but it doesn't need to be because really, in order to read a bond, there are four main things that you need to see. So imagine a bond has a value of £100. If that bond then has a coupon of 4%, you're getting £4 for every year that you hold that bond. This is really where the phrase fixed income comes from, because that coupon is fixed for the entire period of the bond. The second thing to look at is the maturity. That is the time date at which you're going to get all of your money back, your capital will be returned, and it will also help to dictate what that coupon's going to be. As we've already discussed, generally, longer term bonds pay a slightly higher coupon than shorter term ones. The next bit to read is the yield, and this is where things do get a little bit more complicated, and that secondary market comes back in. Because if you've got a bond that you bought on the day it was issued for £100 and the yield is 4%, then we know pretty clearly that you're going to be getting £4 for every £100 that you've put into that bond. But let's say for whatever reason you want to get rid of that bond, or indeed you want to buy it somewhere later down the line on the secondary market. If that bond is now worth £80 because it's not quite so appealing on the secondary market, it's trading at what we call discount. What that means is that ultimately that £4 that you're getting has just gone up as an overall percentage. It's a better yield than if it was £100, because if you now hold it to maturity as well, you'll likely still get all of the capital that was initially invested, so the full £100. You've paid less than £100 to have it, and you're still getting that 4% as well. If the bond is trading at a premium, so let's say it's trading at £105, slightly above that face value of £100, and you hold it to maturity, you might look to make a slight capital loss because you'll get £100 back, but you've paid £105 for it. Granted, you'll still get the coupons, the regular income that comes from it, but the yield, the overall return of the product, has just gone down. So bonds are not just about that very simple what goes in, what you receive, and what you get back at the end, because actually the vast majority of us will be playing on that secondary market. So it's about what the face value is, what it's worth, what you're then getting in income, and how long the bond has still to go, and therefore what the income's actually worth, and how much you're therefore going to get at the end in overall yield as an investment. So as I mentioned, historically, retail investors haven't been as involved in the weeds of the bond market as they are increasingly being allowed as they are now. In the UK, back in January, we had a bit of a change come into place. And this was all about the issuance of bonds and the accessibility that retail investors now have to them. Previously, they were normally issued in denominations of around £100,000, which meant that most of us were either buying them as fractional shares or by buying them through funds, for example ETFs or multi-asset funds. This is where the fund manager themselves has bought the bonds, bundled them up into the fund, and you've got loads of different bonds in there. The question though isn't whether bonds are good or bad, because most of us started this video by knowing the theory that we should have some bonds in our portfolio, particularly if we're closer to retirement. The question is, for whom and when do they make sense? And how exactly should you be accessing them? For me, there's some really set criteria, and I see it almost as like a branch of two trees. They dictate as to whether you'll go down the route of buying direct bonds or whether you'll go down the route of buying bonds packaged up in an ETF or some sort of fund. Let's handle the direct ones. Buying bonds direct is still more complicated than buying stocks direct and than buying funds. All sorts of reason for it: the lower transparency, the way in which the platforms carry it out, some of the costs associated, and some of the minimums that are very much still there. It is more complex. So if you've got more time to be researching it, you've got a genuine interest and a background knowledge, and you understand what you're going into, fine, buying direct might work for you. If you are somebody who is approaching retirement, for example, and starting to introduce cash management and lower risk investments to your overall portfolio and strategy, then direct bonds might be an answer. Here in the UK, they are normally capital gains free. It's always worth checking exactly which and when, but that can come with a real advantage, particularly when we've seen things like the cash ISA limits drop, and if you've already used things like your other ISA limits. Equally, if you want that predictable income that you know you can get from a new issuance of bond or one that you've seen on the secondary market, then this direct approach could work much better for you than a bundle within a fund or an ETF that can be more volatile and change, because buying direct does offer that direct level, does offer that set and predictable income. So in sum, if you are somebody that is approaching retirement, needing that predictable income, wanting lower volatility, and understand what you're buying and have the funds to be able to get involved in direct bonds, then they might be the answer for you. But if you're not falling into any of those categories, or you're a little bit uncertain on some of them, then you might be accessing bonds in a different but totally fine way, which is via either ETFs or within multi-asset, or indeed just actively managed bond funds. Both ETFs and actively managed bond funds are just a big basket of bonds. They'll likely have ones in there that have different maturities, different corporations, for example, if it's a corporate bond fund, different governments, if it's a government bond fund, and crucially, what the fund manager or the ETF manager will be doing is laddering those bonds. So they're consistently buying new ones as others reach maturity. Think of it as like a ladder, all those rungs going on top of each other. If you're doing that as a retail investor yourself, you'll need to be managing those expiration maturity dates and making sure that you're keeping on top of what's coming through and new and buying accordingly. So if you're newer to investing, you're wanting diversification, you're not necessarily looking to be understanding what's going on and trying to split your money between different bonds that might still have quite high levels of entry points, or indeed you're investing smaller amounts that don't permit you to get involved in individual bond issuances, then ETFs or actively managed bond funds may well be your solution. So there you have it, a full 101 on bonds, how they work directly, what they actually look like, and how and whether you should get involved. If you are liking these videos, do make sure that you give me a little like, and of course, let me know if there's anything else that you want to see in future. Take care and see you at the next one.